Now, you have said just this morning you beat expectations in almost all of your major business lines. You said you're gaining market share. Where can we expect you to expand the most in the next 6 to 12 months?
Well, there's still a heck of a way to go, Shanali. Firstly, thanks for having us on. But we've got a lot of things in motion. We've just started really the whole workplace strategy, and we have several million clients that we brought to the firm through Solium and through E-Trade. That's just kicking off. I mean, the asset flows coming to the wealth and asset management business. I think we're about 400 billion year to date in new money that's come in. And then we're continuing to see share gain and extremely good performance across the whole investment banking, sales and trading platform. I don't expect the investment banking pipeline to slow down at this point. It remains very robust. And then as eventually the Fed starts tapering, move to rate increases, you're going to see more volatility in the fixed income space, which we'll participate in. So there's a lot of stuff going on right now.
Well, let's speak to those challenges for a second, James. You had said during your earnings call a little bit earlier to watch out for volatility. Many of your peers have been very worried about interest rates. What are you most worried about as we start to close up this year still?
Well, I think I just said you've got to be mindful. I mean, we're seeing sharper movements in the market by the day. Some of the sort of earlier bubbles around SPACs have clearly gone off the boil a little bit. There's more geopolitical tension between the US, China, talk of Taiwan, et cetera. So I think you've just got to be, our job is to be mindful and to, on the one hand, have your foot on the accelerator, but the other, constantly be looking for where the big potholes are. And that's basically what I mean by being cautious. But honestly, in the next several months, I think the market has digested that the Fed will have to move, not just on tapering, but on rate increases. And by the way, we're 10 rate increases away from what would be considered normal. We could do 10 quarter-point rate increases. So bringing it up a little bit over the next year that's not a crisis and not unexpected.
So you said not a crisis. So do you think that a lot of people who are worried about the next correction in the market, are those fears misplaced?
Oh, the people are always worried. I mean, markets go up and go down, one wise person once said. And, when you've got basically free money, record fiscal stimulus, global synchronized growth, of course the market's going to do well. I mean, whenever are they not going to do well? If this environment doesn't make it happen, none will. But that doesn't mean that it's going to go in a straight line forever. I've been doing this a long time. You have corrections, you have moments of excess, you have reassessments, the investor's psyche changes. We'll go through one of those periods, but I'm not expecting some major crisis. And, nothing like the shocks that we've been through in the last 30 years that were really material.
James, it's Alex. We're trying to understand sort of as we come out of COVID, what a normal environment looks like. As you look at your business.
I hope you've figured that out for us.
Yeah, no, I have not. That's why I'm asking you. What kind of market share, what kind of business do you become when we quote unquote normalize?
It's very interesting. The last 15 years, the very large global US investment banks have gained share. And the scale economics you need and the technology you need to drive these global businesses is so expensive and so intense. It's a real moat around them. So I think the scale economics have accrued to those who were prepared to invest in their businesses and got bigger. Same with wealth management. I mean, wealth and asset management, Alex, we're managing, nearly $6.5 trillion. Somebody can go out and hire a financial advisor here or there or pick up a good relationship, whatever. But $6.5 trillion compounding is a massive number. So I see our future as this combination of the balance of the speed of the investment bank with the ballast that wealth and asset management give us, but both really scale businesses, both, number 1 or 2 or 3 in each of their categories around the world, wealth and asset management combined and institutional combined.
James, good morning. It's Guy in London. All I hear about over here is that portfolio managers are either looking to be paid more or looking to hire people at higher wages. I'm assuming that you're seeing the same thing over there. What is that going to do ultimately to costs going forward, though?
They should be paid. They should be paid well if they've done well, and ours have done phenomenally. So I'm not surprised you're hearing it. It's just a consequence. You got revenues up. Obviously, they're ringing the bell. They're bringing the client business in. They're serving their clients exceptionally. Portfolio's performing well. I would expect the portfolio managers to do well. On rising costs for the industry, I mean, we're in a talent-driven organization, and we're going to do revenues this year. We're a pro forma around 60 billion. So we have enormous capacity around the compensation pools to absorb rising costs for the young kids coming in and so on. That's why we made some adjustments, Guy. I don't see that. That's not a material threat for an organization like ours.
Yeah, and how long does it continue for? You had mentioned that this is not actually just in investment banking. This is also in your wealth business, attracting a lot of people. Do you see this wage pressure on the industry lasting for a while? And what is that going to do in terms of the ability to control expenses at the end of the day?
Yeah, Shanali, I really don't think it's going to be that important to what we do. I mean, this industry understands when markets are good, they're getting paid better. When they're not, they're not. You know, if you don't perform, it goes down. So I think that there are some natural sort of hedges within these kinds of businesses that the traditional companies don't have. So honestly, you know, my focus is on making sure we pay our people well for great jobs done, and they'll get paid great for doing that. That's our focus. But it's not an anxiety around wage inflation for this kind of company. Mm-hmm. Very different industries, obviously, affected dramatically. But what I see is real wage inflation around the world.
Yeah, in that way, you're much more relatively insulated. But let's just go to jobs for a second, James. Last year, you promised not to cut jobs. Is that view changing now as things are, quote unquote, normalizing?
Well, we did, you know, that was something we decided, I think it was back in February, Alex, and we thought there was one thing we could take anxiety off our employees' shoulders was guarantee their job for the year. I mean, they had enough dealing with COVID and all the health issues and the economic issues going on around them and their families. We thought that was the right thing to do as part of our core values of do the right thing. You know, we're in a different place this year. We guaranteed everybody their job, but we're not looking to cut jobs. I mean, we're actually trying to hire people. So we get over 100,000 resumes a year, as you would imagine. But, you know, we've had some attrition, but not great. And we had very little last year. So, you know, we've certainly got a lot of open positions here. And we're not, you know, there's no major job cutting exercise that I see in the future at all.
James, you mentioned inflation just a moment ago when you talked about wages. Inflation is going up broadly in a number of areas at the moment. Listening to what you've said, both in this conversation and on the call a little bit earlier on, you seem pretty confident about the trajectory we're on. You see clearly some bumps in the road. But you don't see inflation getting out of control. You see this as being something that we can manage our way through.
Well, you know, I mean, that's my assumption is that the Fed will manage through. I mean, they'll have to bring rates up. My prediction, Guy, has been for a long time, I've been much more hawkish. I would have brought rates up, you know, certainly by the first quarter of next year, I'd start moving. They have a lot of capacity to move, and I think you've got to prick this bubble a little bit. Money's a bit too free and available right now. So, yeah, we're seeing, you know, and I'm not a buyer of this story that it's all transitory, the inflation story. It's not transitory. I mean, wage inflation is real, and the supply chain interruptions, and you were talking about some of the natural gas and other things, have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now. And you saw that in the dot points that came out at the last FOMC meeting. I think, if I'm right, there were 5 dots for a rate increase in 2022. That moved to 9 dots at the next meeting. So we're seeing it through the Fed's own numbers.
I really appreciate the really clear language about the inflation outlook there, James. You know, you also said today that Asia was a really big part of your gain in equities this quarter around. Obviously, when it comes to China, we've seen a lot of volatility built around those crackdowns. How do you view the region and its ability to help you push forward in the next few months or years?
Well, we have a huge business in Asia, but, you know, all the way from where I grew up in Australia through to Japan with our partnership with MUFG, and obviously China, Greater China, Hong Kong, and through Southeast Asia, Indonesia, and Singapore. So it's actually quite a diversified business. We're not oversized in China. I mean, relative to the opportunity, we do very well. We're number 1 or 2 in a lot of the markets. We have an A-share license through a company called Washing Securities. But we're not oversized. We've got, you know, all of our wealth business, 95% of that is US based. So we have a huge buffer in that we're very US centric with our wealth business, asset management more diversified, and the institutional trading businesses are really, you know, they're diversified geographically. So China is obviously critical to us, but the current tensions and whatever happens as a result of that is not going to change the fundamental trajectory of Morgan Stanley.